Hi, I'm Jimmy. In this video, we're going to look at Realty Income, ticker symbol O. So what we're going to do in this video is we're going to look at what makes Realty Income interesting and appealing to many investors, especially dividend investors. And then we're going to look at where Realty Income could be a good buy. Is it a good buy today at the current price? Okay, so first, let's touch quickly on what makes them interesting. So Realty Income is a real estate investment trust, or REIT for short. And basically what a REIT does is it's a company that invests in real estate and essentially takes what they make from that real estate, brings it into the company, and pays most of it out to dividends to investors. And that's how they get a dividend history that looks like this. So as we can see, they've been paying about 23 cents a month in dividends, and this can be quite appealing to many dividend investors because of the frequency. They've consistently increased and continue to pay their dividend for many years. And right now, Realty Income has a dividend yield of just short of 5%. So it's a solid dividend yield. Okay, so let's look quickly at what Realty Income does, or really the type of real estate that they own and that they manage. So this is a pie chart of the types of properties or the types of tenants that Realty Income has. And as we can see, they're very well diversified. This came off of their most recent annual report. And on a recent investor presentation, well, I read that they have 6,588 commercial real estate properties. And those properties are in 49 of the US states, plus Puerto Rico and the United Kingdom. Now, the reason I decided to make this video on Realty Income is I came across this one in my research where I was researching 5 REITs for long-term investors. And Realty Income did not make that list, even though I'm a fan of this particular REIT. But here's why I hesitated to add that to this list. And then we'll jump into the valuation of Realty Income. Okay, so basically, they've been unable to collect some of the rents on the properties that they own because of COVID. Just to illustrate, a small percentage of their convenience stores locations were not collected during the third quarter. So that's not a great situation to be in. Plus, as we could guess, their health and fitness, many of the health and fitness properties were not collected either. And even worse than health and fitness were their movie theaters. Movie theaters, about 3/4 of their movie theaters didn't pay rent during the third quarter. So that's a pretty large percentage of tenants to not be paying rent. So I think that that's a negative thing. By the way, the movie theaters not paying rents was a large part of the news. And I actually think that the market overreacted to that, but I understand it being an issue. And that was ultimately the reason why I hesitated to add them to the previous list. But I don't want to make it sound like they had a large percentage of their overall properties, of this entire pie, not paying rent. In fact, they collected about 93% of all rents due. So that's still a great number. I just hesitated to add it to the list because when I was first starting the research, I came across mostly the headline news about the movie theaters. I didn't do this deeper dive until I got ready for this video. Hence the reason why I'm diving deeper now. So the real question in my mind, as far as the properties that are not paying rent, is when and how fast do they come back online? Now, just recently they've talked about perhaps some vaccines coming to market. And when we see that, oftentimes we'll see a huge spike in this stock price because it's been very reactionary to the COVID-19 crisis. So any negative news that comes out, there could be an opportunity here. But again, let's now dive into the numbers to look closer at where that opportunity is best. So before we leave this slide, I do think it's important to note how well diversified they are. That's a fantastic thing, especially for dividend investors. So that's one part of the numbers to keep in the back of our minds. Now let's shift over to debt. So we can see that their debt has been steadily climbing for many years. And at first glance, it looks like this could be a very bad thing. But as we may know, real estate is often backed by mortgages. It's often purchased with the help of mortgages. So perhaps an increasing debt isn't too surprising, as long as those debts are used to, in theory, get more real estate. And when we switch over to the real estate value, these are listed on their balance sheet, well, we can see that their real estate values have also gone up over this very same time period. And just to be sure that these numbers were actually comparable, I actually created this chart. Now, this is a chart where we take the current debt load and divide it by the value during that year. And we can see that they've consistently been in the 50% range. So it doesn't appear that debt has consistently increased relative to the overall value of the overall portfolio. Okay, so now let's move on to valuation. To come up with the fair value for a REIT, well, there's a couple good choices. One of the first and best ones is to come up with something known as net asset value, or NAV for short. And basically, it's the value of the real estate itself minus any liabilities that the company may have. And in theory, we want to pay less than that. If you can pay less than what the real estate is actually worth, that's a great thing. You should do well over the long run. Now, this can be tricky to calculate because we're not talking about the fair value of the properties listed on the balance sheet like this chart is. That's what this chart used. We're talking about what is the real estate actually worth. Could we figure out what a property is worth? Just as an example, let's imagine that we owned a house and pretend we bought that house 10 years ago. And if we paid, just to keep the math simple, $100,000 for that house, or $500,000, or $1 million, or $10,000, whatever the number is. If we paid X for that house 10 years ago, well, what is it worth today? Because what we paid 10 years ago, after depreciation, is what ends up on the balance sheet. But until that house is sold, we don't know what the real value is. That's the value we'd be trying to calculate. What are all of their properties? If we go back to this pie chart here, what are all of those individual properties worth today if they were to liquidate the whole company and sell it? And as we can imagine, that's a bit of a tricky thing to do since most REITs, including Realty Income here, well, they don't keep that type of information in their filings. So the best we can do is estimate that, and there are ways to sort of try to back into that number to do a reasonable job at it. And if you're curious, I can do a video on how to do that. But another good option is to use something called price to funds from operations, or FFO for short. So if you want me to do the NAV video, please let me know in the comments below. But for now, we're going to use price to funds from operations for Realty Income. So this is a chart of Realty Income's price to FFO going back the past few years. And the average over this time period is it's a bit short of 21x. Right now, they're trading at about 19x. So if we were to switch over to their price chart, and because their current price to funds from operations level is lower, it implies that they could be undervalued. But if they were trading closer to their average, let's say we believe that their average is where they should be trading. Well, right now, based on their funds from operation over the past 12 months of $3.33 per share, they should be trading at about $68 per share. So based on this valuation, there looks like there could be a bit of upside. Now, this brings us to the question, do we think that we should buy Realty Income today? After all, it does pay about a 4.5% dividend yield. And to me, I like this REIT very much. I really like what they do, and I do think it is a good long-term holding once we get past COVID. But I'd like to wait for a bigger margin of safety. I much prefer to add a buffer to our calculation. So if we say it's worth $68, I want to buy it with a reasonable buffer, a reasonable margin of safety below that. So for me, I'd like to see this stock drop at least 15% more before I would consider getting involved with it. Now, if you already own it, I think it's a great buy and hold investment. So if you already own it, I would just sit on it. But for me, I'd like to see it drop at least 15% more before we got involved. Now, if you're curious how to come up with a reasonable margin of safety, well, I actually did a video where I talk about when to buy a stock and how to come up with a good margin of safety. So perhaps that could be a good next video for you to watch if you're curious. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thanks, and I'll see you in the next video.